Welcome back to Investing Talk Podcast.
Today we're looking at Bitmine Immersion Technologies, a unique player positioning itself less as a traditional miner and more as a powerful leveraged proxy for the Ethereum ecosystem.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For anyone who, thinks they know this company from their old operations, you really need to throw that model out the window.
Okay.
The whole narrative has fundamentally shifted. We are looking at a really radical strategic pivot toward becoming a crypto treasury and network company.
Right. So this isn't just about plugging in ASICs anymore.
Not at all. It's about balance sheet management and infrastructure.
That pivot, it sounds brilliant on paper, but how difficult was it for a traditional mining company to execute such a radical transformation? I mean, you're moving from operational risk to pure balance sheet risk. And how deep are they into Ethereum?
They dove in head first. I mean, the result of that pivot is that they are now the world's largest corporate Ethereum treasury holder.
The largest.
The largest. This is a monumental shift. They made a very strategic choice to accumulate ETH, positioning themselves to capture the upside of the entire Ethereum ecosystem, not just, the marginal profits of mining.
And when you look at the scale of that accumulation, it really is staggering. The company currently holds 3.86 million ETH tokens.
3.86 million?
To put that in perspective for you, that represents more than 3.2% of the entire circulating Ethereum supply.
It's incredible.
That's nearly 1 out of every 30 Ether tokens that are currently in existence. What kind of leverage or influence does holding that much of the supply even give them beyond just tracking the price?
Well, it's massive, and it raises a few points. First, it gives them that unique leveraged exposure to ETH prices. But second, it provides a very high level of network visibility and potentially influence, especially as they move into validating the network themselves.
So they become a systemic player.
It's exactly a critical systemic player in the crypto infrastructure world, not just a passive investor.
And that strategic concentration, that forms the bedrock of their whole financial standing. When we look at their total crypto holdings, plus cash, plus investments, which includes their stake in 8 co-holdings, the total stands at a massive $13.2 billion. And crucially, their current market capitalization is tracking almost dollar for dollar with that stated net asset value, which tells me the market fundamentally believes in the value of that asset base.
That financial foundation is critical because it led directly to the massive earnings inflection they announced for fiscal year 2025. While historical crypto companies are known for volatile or even non-existent earnings, Bitmine announced $328 million in full-year net income.
And the fully diluted earnings per share figure is what grabbed my attention. $13.39 EPS. That's a number you usually associate with, like, highly stable, profitable giants. For a crypto-adjacent company to post that, it signals a complete transition. The question is, how much of that is just asset appreciation and how much is operational strength?
That's a great question because we often see crypto companies whose balance sheets look good only because the asset price went up. But here, the operational strength is also really robust. Fiscal year 2025 revenue, separate from pure asset gains, grew 62% to $510 million.
$500 million in revenue.
$500 million. And that's proof of underlying business strength, showing they're delivering services and generating income through other means, not just watching price charts.
And they run a remarkably clean ship financially. Their balance sheet is strong, reporting $87 million in cash versus only $22 million in total debt as of Q3 2025.
Very little debt.
It's so capital efficient, which is exactly what you want to see when you have such a leveraged position on the asset side. They aren't relying on massive debt to finance their operation or their treasury.
And that brings us perfectly to the next point. We've established this massive money pile they've built through accumulation. Now, let's talk about how they actually build a wall around their business model. What's the competitive moat here?
Right. What separates them from any other fund that could just go out and buy ETH?
It's their technology.
The moat is proprietary technology. Their competitive edge is their proprietary immersion cooling systems for data centers. Everyone knows cooling is the single largest operating cost in large-scale data facilities.
Exactly. And the key takeaway here is efficiency. This tech reportedly reduces their data center operating costs by 15 to 25% per terahash compared to the standard, highly inefficient air-cooled miners.
15 to 25%. If you imagine running a massive industrial facility, saving that much on your energy bill is just a colossal advantage.
It fundamentally shifts the entire margin structure in their favor.
And they aren't just keeping those savings for themselves either. They've found a smart way to monetize that technology by offering their infrastructure services via a mining as a service, or MAS platform.
Plus, they generate synthetic Bitcoin mining revenue. So that operational diversification means they aren't purely reliant on Ethereum.
And we can see the demand for this high-efficiency infrastructure in the financials, can't we?
Oh, absolutely. Customer advances, which is essentially prepaid revenue for future services, surged 156% leading up to May 2025. That indicates really strong institutional demand from clients who want to leverage Bitmine's efficiency without building it all themselves.
So the whole thesis kind of boils down to this. They acquire the core asset, which is the ETH. They use their proprietary tech, the immersion cooling, to keep their operational costs low. And now they're solving the final piece of the puzzle, generating consistent yield.
That's absolutely right. The next step is critical, turning that massive passive ETH treasury into a high-margin recurring revenue generator. And this is where their planned EVAN, the Made in America Validator Network, comes in.
A EVAN is slated for deployment in early 2026. Explain for us why this is considered such a structural game changer for the company's future cash flow.
Okay, so it moves them from relying purely on asset appreciation, which is volatile and non-recurring, to earning passive income. When you stake Ethereum, you essentially lock up your tokens to help secure the network, and in return, you earn a yield, much like interest.
Okay.
So with 3.86 million ETH tokens, staking immediately introduces a high-margin, predictable revenue stream that can stabilize their earnings regardless of short-term price swings. It changes the company's fundamental risk profile.
And that yield is expected to flow directly back to shareholders, which is a huge move toward financial maturity. Bitmine recently declared its intention to offer an annual dividend tied specifically to the ETH Treasury yield.
Yes, precisely.
Why tie the dividend to the Treasury? Is that a structural move to attract yield-focused investors?
Yeah, it is. It's a very clever move that bridges the world of volatile crypto assets with the world of traditional finance and dividend investors. It says to the market, we are confident in our long-term ETH holding, and we are going to use the native yield from that asset to provide consistent capital returns.
Which is a significant signal in the crypto space where capital returns usually only come from selling the asset itself.
Exactly.
Okay, let's transition into momentum and catalysts. If you're going to bet the farm, or $13.2 billion on a single volatile asset like Ethereum, you need some high-caliber backing to validate that strategy.
And this company has it in spades. The roster of high-caliber institutional backing is phenomenal. I mean, you're naming key supporters like Cathie Wood's ARK, Founders Fund, Bill Miller III, Pantera, Kraken, DCG, Galaxy Digital, and Thomas Lee as well.
Do these big names just validate the strategy, or do they also provide a necessary stabilizing force?
They absolutely provide a layer of institutional conviction and external governance pressure. For a firm like ARK or Pantera to put significant capital into this thesis, it suggests they've done the deep, complex regulatory and tech due diligence that smaller retail investors just can't do.
Right. It provides comfort to the broader market.
It does.
And that conviction is certainly reflected in the share price momentum. The stock has seen a one-year share price change of approximately 387%. That reflects the market's enthusiasm for this whole ETH Treasury story and the impending Mavan launch.
And it's highly liquid. It's sitting as the 37th most actively traded stock in the U.S.
So from a technical perspective, that momentum is strong.
Very strong. Trading consistently above both its 50-day and 200-day moving averages suggests a powerful underlying bullish trend that has attracted that deep liquidity.
So if we look out over the next, say, 0 to 3 months, what specific events should you be watching for? What's the catalyst stack that could send this even higher?
The first key date is the annual shareholders meeting on January 15th, 2026. This meeting, held in Las Vegas, is going to be the critical moment for management to give the market detailed updates on the Mavan launch timeline and, crucially, the finalized dividend policy.
Right, the structure and the economics of it all.
Yeah, investor expectations around that yield generation will be very high.
We also have those supportive macro tailwinds coming in simultaneously. The Fusaka Ethereum upgrade that activated back on December 3, 2025, that's a positive development for the network's stability and crypto valuations in general.
And you can't ignore the macro environment. Anticipated Fed rate cuts signal an easing monetary environment, which historically boosts risk assets, including crypto. These factors act as powerful, non-company specific tailwinds for their levered ETH exposure.
We also have some interesting speculative catalysts circulating. There's market chatter surrounding potential index inclusion, right? Whether that's the S&P 500 or the Russell 2000, given their growing market cap and trading liquidity.
Yeah, and index inclusion means passive funds have to buy the stock, regardless of their own investment philosophy.
A huge deal.
And the company has been positioning itself for a major financial event. Strategic restructuring steps, like the reverse stock split earlier this year and filing a Form S-3 shelf registration, strongly suggest they're preparing for an uplisting to a major exchange in 2026.
For our listeners, why is that S3 filing such a strong signal?
An S-3 shelf registration gives a company the flexibility and speed to quickly raise capital on a major exchange. It's essentially regulatory prep work. It signals that management is serious about accessing larger, more conservative institutional pools of capital that often require a listing on the Nasdaq or NYSE.
So it opens the door for those massive, passive institutional inflows.
Precisely.
Okay, all these upsides sound phenomenal. A massive treasury, institutional backing, a proprietary moat, a clear yield path. But as we always stress, the risk assessment is non-negotiable. What's the massive red flag? It has to be that extreme reliance on one coin, right?
It is absolutely the concentration risk. The company's entire net asset value, and thus their stock price, is tethered directly to ETH price volatility. This market is cyclical and notoriously volatile.
As we saw with that recent 9% one-day drop.
Exactly. That volatility is the necessary entry toll for this type of asymmetric exposure.
But is that volatility already priced in, or is the market being overly optimistic about these future profits?
To some extent, the risk is priced in. The stock is traded with a surprisingly low PE ratio in some analyses, sometimes as low as 2.60.
A PE of 2.6.
Yeah. For the listener, a PE that low for a high-growth sector suggests the market is deeply skeptical that those massive recent earnings are sustainable. It implies the market is treating current profits as a one-time windfall, not recurring income.
Which makes it a potential value play if you believe in the long-term ETH thesis. We also have to address the corporate governance and execution risks. There was news of a board resignation, and they have a proxy vote outstanding for a massive increase in authorized shares, which always signals potential dilution risk.
Those are valid points, particularly the potential for dilution. However, the sheer presence of that high-caliber roster of sophisticated institutional investors, Arark, Pantera, Galaxy, it provides a powerful layer of external governance pressure. The capital, when raised, is often used for strategic accumulation during dips or for essential infrastructure build-out, like Malvin.
And speaking of Maven, execution risk is always present when you're launching a complex, high-stakes tech platform.
That's correct. The success of the staking platform is not guaranteed. But their focus on developing Malvin as a secure, U.S.-based and compliant staking solution is key. By building it domestically and with a high compliance bar, they're trying to reduce future regulatory friction, which is a major long-term win, even if the launch timeline shifts a bit.
So synthesizing the entire picture for you, this is a unique asset play. You have the largest corporate Ethereum treasury in the world, backed by institutional giants, utilizing proprietary immersion cooling tech that cuts costs and provides a moat, and a clear strategic path to high-margin recurring revenue via the Maven staking platform and a dividend.
Exactly. BitMine presents a compelling, high-conviction opportunity for investors seeking that scaled, leveraged exposure to Ethereum, supported by operational efficiency and numerous near-term catalysts. This is not a quick trade, though. The investment horizon is best viewed as a multi-year hold.
Right. You need to capture the full ramp-up of the staking platform and the anticipated regulatory clarity to see the true value unlock.
It fundamentally boils down to how much you believe in the long-term future of Ethereum and whether this company can successfully transition from being merely a holder of the asset to being a critical generator of network yield.
If they pull off Maven, they redefine the corporate crypto holding model.
This strategy also raises a fascinating question for the entire crypto space. If the largest holders of a decentralized asset are traditional publicly traded corporations, what does that mean for the future governance and regulatory profile of the Ethereum network itself? Something to consider as Maven rolls out.
A fantastic point for you to mull over. If you found this analysis helpful, make sure to hit that subscribe button and leave us a comment below. We'll be back next time with another exploration into the markets.